Welcome, my name is Vishal Tekshanani and I'm Nabtrade's content editor. Today I'm joined by Morphic Asset Management's Chief Investment Officer and Managing Director, Jack Lowenstein. Jack and I are going to talk about Morphic's investment philosophy, and we're also going to talk about the new listed investment company they're bringing to the market, the Morphic Ethical Equities Fund. Jack, pleasure having you here.
Great to be here. Thanks very much for having me.
Jack, so let's talk a bit about Morphic. What's the background of the company and who are the key investment members?
I spent my entire investing career at a place called Hunter Hall, and in late 2011 I decided it was time for a change. When I left, one of my protégés and one of my most brilliant colleagues, Chad Slater, said, well, if you're out of here, I'm out of here too. And we set the business up. We then made probably one of the best hires I've ever made, a guy called Jeff Wood, who is our risk manager and head of macro. And we built the business slowly. About 2 years later, Westpac decided to buy a 1/3 stake in the business through their fund investment arm, Ascalon, and we've been growing steadily ever since.
So can you talk to investors about the investment philosophy?
Yes, okay. Well, first of all, in terms of our investment philosophy, we believe it's very important not to be style bound. You'll meet people who say you've got to be a value investor or a growth investor, and our view is you want to find stocks that are generally reasonably priced with good growth prospects, and signs that you're going to be right in terms of the momentum of their earnings and the earnings revisions and the share price itself. So when we can find things that have those characteristics, we get very excited.
Okay, and the emphasis on ethical investing. So let's talk more about your listed investment company. You're bringing a new LIC to the market. What are the key characteristics of this offer?
Well, the key characteristics are the ethical screen, both negative, as in we won't be investing in fossil fuels, in armaments, in gambling, in things like rainforest logging and so on. And we're also going to have, at all times, at least a small exposure to things that we think will make the world a better place. And we're really mostly looking at things like companies that invest in clean energy or good use of water or do things for air quality. Those are the big things as far as we're concerned. And then on the investment style, our returns at the Morphic Global Opportunities Fund, which is the unit trust we've been operating since we started, have been targeted to be very low volatility. We think investors don't want to see great results for a fund. You know, you're up a huge amount, and then you join that fund and find that the next couple of years are down.
Sure.
And so low volatility is very important for us.
And that's a great segue into your investment process. So can you outline to investors, how do you take a position in a stock, long or short, and then how do you manage the risks around the portfolio in order to, well, firstly, just manage the risks and make sure you're not investing in stocks that are going to crash, but also keep the volatility of the fund fairly stable?
Okay, well, in terms of, obviously, the key thing is to do your research properly. We don't believe, by the way, that you should investigate a stock for 3 months and find it's gone up 50% and then feel you have to buy it because you've been investigating it for so long. So you want to investigate the stock clearly and make sure you've aimed at the right things and then move aggressively when you've got that. Now, the counterpart of that is making sure that you work out from a risk management process what you're willing to lose. Now, we all enter every investment full of optimism. We found the next big thing. But I think that the important counterpart of that is to actually say, I could be wrong. We all are wrong from time to time. And how we recognize that is to say, I'm only willing to lose, typically in our case, a maximum of 0.5% on any position, 0.5% of the overall fund. And then we size our investment in each stock or position based on that maximum risk tolerance. And if we hit that maximum risk tolerance, that's the point at which we say we have to recognize we've been wrong.
Well, why don't you outline 2 portfolio positions that you've taken?
Okay, at the first start, we think that US regional banks are a very fertile ground to look at, provided you take a medium-term perspective. We're never going to know as much about the next quarter's results in the US as a US investor. But if we can find an opportunity to invest for the longer term in companies with great management and some unique franchises, as we are in America at the moment. We've got an investment in a company called Bank of the Ozarks, which has been the best growing bank in America for the last 2 decades.
Never heard of it.
No. Western Alliance, which is based in Arizona. Bank of the Ozarks is based in Little Rock, Arkansas, Bill Clinton's hometown. Western Alliance is based in Arizona. And we also like a stock called Bank of Internet, Yes, it does exist. That is a thing, which is probably the best fintech bank in America. It operates a branchless banking business and is growing very rapidly.
Okay.
So that's one area we like, and we think that the macro setting of probably rising interest rates in the US is going to help them. And the other area that we really like, we think South Asia is full of risks, but it's also full of excitement. By that I mean India and to a lesser extent Pakistan. We think these are economies where
clean energies.
There's a lot of opportunity for clean energy, a lot of opportunity for growth. But both countries, I think, have very, very vibrant private sectors. They have governments that are getting better. They're still not perfect, but they're getting better, and that's a very powerful trend. So we like that, and we think there's some very cheap stocks in Japan, particularly in areas like housing, where there's this constant fear that house prices have gone up too much because they've gone up a couple of percent a year for the last few years. It sounds like nothing in Australian terms, and we think there's some very good opportunities there.
Okay, so we've talked about your investment philosophy, we've talked about how you're managing risk in a portfolio perspective. All right, now you did give me permission to grill you, so I'm going to ask you one last question. I'm going to ask you a question.
You smell the burning flesh out there.
When we think about the timing for this offer, Warren Buffett just published his annual shareholder newsletter for Berkshire shareholders. And he made a comment about active managers, and I want to ask you for your response. And he said this about active managers. The bottom line is that when trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not the clients. Both large and small investors should stick with low-cost index funds. Now, I know we're not on Wall Street here, but the concept is still the same. What would you say to that?
Well, two comments. One is we don't, unfortunately, charge the kind of fees that people do. In America, the kind of fees he's talking about are so-called 2 and 20. There's apparently a city in Greenwich, Connecticut, where a lot of hedge fund managers live, where the joke is the speed signs, the speed limits say 2 and 20. We don't charge 2 and 20. We're charging 1.25% management fee, and our performance fee, we get 15% of outperformance over the index. We don't even get that unless we're actually making money for investors. So I think we've tried to get the fees at a level which is enough to keep the business operational, because there are costs associated with this, but at the same time are fair to investors. Now, in terms of index funds, he makes a very good point. We have written on this quite a lot, and again, there's stuff on our website about this, but we believe that index funds are good for many purposes. But ultimately, if too much money is being managed in index funds, then the capital markets won't work that effectively, because basically you're saying every stock's the same, and therefore we're going to give a proportionate weight into every stock. Our approach is to try and find opportunities between the cracks. Now, the less people doing that, the more opportunities will be available.
Jack, thank you so much for your time today, and good luck with your listed investment company float.
Thank you very much.
To our viewers, hope you enjoyed that video. If you are considering investing in the listed investment company, please be sure to do your research and consider seeking financial advice if that's appropriate for you. Thank you so much for your time, and we hope you enjoyed the video.